Okay guys, so now we will look at the two questions that we are given in section 3. We have already completed our discussion on section 2. So there were 4 questions where they allocate 10 marks each, so altogether 40 marks. Now we are going to look at section 3. So there you get actually 2 questions only, however they allocate 20 marks each. So 2 questions, but at the end of the day you are in a position to score 40 marks from this area. So this is also one of the important areas in your paper. So once you are done with it, we can look at section 1 where we get MCQs. So straight away, without spending much time, let's look at the answers to these questions. So here all the questions are compulsory, so there is no option for you, there is no choice. And total mark for section 3 is 40 marks. So there, as I mentioned, you get 2 questions where they allocate 20 marks each, and the recommended time is also provided to you, so 72 minutes. So you have more than actually 1 hour to answer these 2 questions. So you have substantial time to answer these 2 questions. So actually you should not complain about the time allocation when it comes to CL4. You have enough time to answer all these questions, right? And they don't anyway expect you to write lengthy answers to any of these questions. So you have to be precise, you have to be specific, and you have to answer according to the questions that you have been given, and you need to read the facts of these questions very carefully before answering. And on top of that, you have the opportunity to refer to the Companies Act because it's an open book test. Therefore, whenever you want, you can refer to the relevant provisions from the Companies Act as well. So here, question number 6, the first question that you get under section 3. New Savia Private Limited was incorporated in December 2020 under the Companies Act number 7 of 2007. The first annual general meeting of NPL was held on 30th September 2021, and its minutes were approved by the majority of the shareholders in October 2021. Rashmi, hereafter known as R, the company secretary, has informed the directors that an annual return must be filed by NPL at the Registrar of Companies. So now the moment you see this question, you have to get an idea, right? They are going to check your knowledge on annual returns. So you know the chapter, if you look at chapter 5 in your syllabus, in your textbook, so there you would have discussed, you have definitely discussed about meetings, resolutions, and the maintenance of documents, records, all those things you have discussed under chapter 5 in your syllabus. So there you would have learnt about this annual return in detail. So the directors in turn queried from Rashmi in this regard. So unfortunately, these directors are not aware of the content of an annual return and the purpose of filing an annual return. So as accountants to be, as chartered accountants to be, you are very well aware the whole purpose of filing an annual return. I'll come to that. First of all, we will look at the requirements of this question. The directors in turn queried from Rashmi in this regard, what is this return? What is this annual return? So it's a very basic question. So there is a query, a question asked by a director of your company, and you are the company secretary to this company. So you have to answer their simple and straightforward question. So straight away you can refer to the relevant provision from the Companies Act. Is there a statutory obligation to file this return? Is it mandatory to file this return? Statutory means a requirement, an obligation under the Companies Act. So the Companies Act is a statute. So under this statute, you have an obligation, do you have an obligation to file this annual return? And who should sign the return? Who has the responsibility to sign this return? Meanwhile, Virat, one of the shareholders of NPL, suspects that fraudulent activities are taking place at NPL with the involvement of its board of directors. As a result, he wishes to inspect the following documents. So, this also from the same chapter that I was referring to, your ability to inspect documents. So, now every company has a mandatory or statutory obligation to maintain certain records. You know, they have to maintain accounts, they have to prepare financial statements. Apart from that, they have to maintain certain registers, the register of the shareholders, the directors register, the secretaries register, and then we have the interest register. You have to maintain the charges register. So, likewise, there are certain registers you have to maintain on behalf of the company. It's a mandatory requirement. Apart from that, some of these documents, some of these records must be made available to the shareholders, the directors and the general public. So, if you look at the Companies Act, I will come to that in a while. I am just laying the background to explain my answer to this question. So, you will see under this area, you must be normally familiar with these aspects. So, what are the type of records that must be maintained by a company? There is a list of documents provided in the Companies Act. What are the records that you have to maintain as a company? So, I mentioned some of those documents that must be maintained. Then, so you don't have to actually memorize it because that list is provided to you in the Companies Act. But only thing you should know from where to find it. Then there are certain records that can be inspected by certain parties. So, there are certain records that can be inspected by the directors of a company. Normally, they have access to all the records because they are involved in the management of the company. But if you are just a shareholder of the company, not a director, merely a shareholder, in that case, you are not permitted to inspect any document you like. The Companies Act specifically permit you to inspect only certain documents as per the Companies Act. So, you should know what documents can be inspected by a shareholder of the company. Then we have other provisions in the Companies Act where it permits the general public, any third party, to inspect certain documents. So, shareholders are normally the owners of the company, therefore, they are permitted to inspect certain documents, but when it comes to the general public, they don't have the same privilege to record all the documents that can be inspected by a shareholder. However, there are some documents such as the Certificate of Incorporation, the Articles of Association, the Shareholder Register, the Directors Register, Secretaries Register, so that even Charges Register. So, those documents can be inspected by any third party, but if you are a shareholder, then there are certain other documents that you can inspect. So, I will come to that when I am explaining the answer to this question. So, as a result, he wishes to inspect the following documents. So, that is the thing. You have to refer to the relevant statutory provisions and decide whether this person who is a shareholder of the company, whether as a shareholder, whether he is permitted to inspect the documents that you have been given here. What are those documents? The minutes of the annual general meeting for 2021, as he had not got a copy of it. Then its interest register, the personal tax return of the chairman of NPL, since we got to know that it had been prepared by the accountant of NPL. So, now let us look at the required part. Explain and provide clarification to the directors queries on the annual return. So, we know there are 3 questions that have been asked by the directors with regard to this special document called the annual return. Then explain to V, who's a shareholder, whether he is permitted under the Companies Act number 7 of 2007 to request NPL for the inspection of these documents. So altogether allocated 10 marks for this area. Right, so let's first start with the annual return. So there are 3 questions asked by the directors with regard to an annual return. Now, what is this annual return? That's the first question. Actually, the annual return is a snapshot. What is a snapshot? I mean, you don't have to explain like that, you should not explain like that, but to understand it practically. Now, when you prepare a balance sheet for a company, since it's something that you guys are familiar with, balance sheet is a snapshot which explains the financial position of the company as of the balance sheet date. The assets, liabilities, capital on the balance sheet date. So it's a snapshot. It doesn't explain the situation before the balance sheet date or after the balance sheet date. As of the balance sheet date, these are the assets, liabilities and capital this particular company is having, right? Now, annual return is also something like that. Now, there, if you, there is a specific schedule allocated under Companies Act which explains the content of an annual return. Now, it's a mandatory requirement to file this annual return, and there is a particular form for this. We call it Form 15. Form 15 is applicable for private and public limited companies. There is another form called 15A, that's something applicable to companies limited by guarantee. But in this instance, the question is clear. It's a private limited company, so you have to file Form 15. So it's a 5-page document. If I remember right, you get 5 pages there. So you have to give a very important detail or information with regard to your company for that particular accounting period, for that particular year. Because normally this annual return must be filed within 30 working days from the end of the annual general meeting. So the question is very clear. They have already had the annual general meeting. So after having the annual general meeting within 30 working days, you have to file the annual return, and the content of the annual return is actually based on this 5th schedule to the Companies Act. So 5th schedule, if you look at it, obviously it's in the Companies Act. Take the Companies Act and see, it explains the content of the annual return. So normally what kind of information that we provide through the annual return? Obviously the name of the company, the registration number of the company, the registered office, and then at the end of the year, the directors of the company, at the end of the year, who are the shareholders of the company, their details, and the percentage of the shareholding, who is the auditor of the company, who is the company secretary. So likewise, the very important information pertaining to the company and the changes that have taken place during that year must be recorded in the annual return. So if the shareholders have left the company since the last annual return, that kind of information also you have to provide. And apart from that, since it's a private limited company, towards the end of the Form 15, which is the form that we file that's a form relevant for the annual return, Form 15. So there, basically, if you are a private limited company, the directors of the private limited company have to make a declaration saying that they have complied with the relevant statutory provisions of the Companies Act during that year. And then who has to sign this annual return? As per the provisions of the Companies Act, the annual return must be filed by a director and the company secretary. They are the people who should sign the annual return. So I have actually, during this explanation, introduction, I have already answered all the 3 queries made by the directors of the company, but let's go one by one. So what is this return? So for that, what you should do is, you need to look at Section 131 of the Companies Act. You need to look at section 131 of the Companies Act. So let me get hold of the Companies Act here. So the relevant section here is section 131. So let's look at section 131 of the Companies Act. So then it explains what an annual return is. So there is so you can see I have already highlighted that part. So subject to the provisions of subsection 3, every company shall at least once in every year deliver to the registrar an annual return in the prescribed form. So I told you form 15 is the prescribed form containing the matter specified in the 5th schedule there here too. So if you look at now, normally when I explain this to my students, I always say, whenever you study, sometimes there are certain sections that you cannot understand alone. They are not standalone sections. For you to understand the section properly, you may have to refer to some other sections as well. Sometimes you may have to refer to a schedule given under the Companies Act. So if you look at annual return, you have to definitely refer to the 5th schedule to understand the content of the annual return. Then apart from that, it's not mentioned here, but the relevant form is form 15. What you can do is, you go to the Registrar of Companies website, then there is you can freely download most of these forms. So one such form that can be downloaded freely is form 15. So when you go through it, you really understand what you get there. So then you understand it practically as well. So whatever you have in the Companies Act, whatever you have in the 5th schedule, we have implemented it practically through form 15. So when you take 131, the 5th schedule and form 15, then you obviously in a position to have a very good understanding about this annual return. So that's how you have to learn it. So here what you should do is near 131 mention about form 15, mention about the 5th schedule, go to 5th schedule and there refer to 131. If you go to the 5th schedule, there anyway they have mentioned about 131. So they are interlinked, and that connection you need to understand, then it's easier for you to answer any of these questions. And I told you the annual return shall be completed within 30 working days from the date of the annual general meeting. So sometimes there are certain companies without having an annual general meeting, whatever the business that must be discussed at an AGM can be done by way of resolutions. We call them resolutions in lieu of meetings. Resolutions in lieu of meetings. So that's another area, but it's not relevant here. So in that case, either from the date of the annual general meeting or from the date that the resolution in lieu of meeting was passed, within 30 working days, you have to submit the annual return. And the content of this return you can find in the 5th schedule, and the practical application of this 5th schedule you can see on form 15, right. So what is the annual return? So there you have to give a very simple answer here. You have to give a very simple answer. So there, as per section 131, all companies are required to deliver the Registrar of Companies an annual return which contain details specified in the 5th schedule to the Act. So you mention section 131 and you mention the 5th schedule also, and if you really want as an additional thing, you can refer to form 15 as well. So that's a form that you have to file. So the answer is here. If you look at subsection 1 of section 131, that gives you the answer what an annual return is. So it's a simple thing. Then the next question is there a statutory obligation to file this return? So obviously, because if you read the section, it says, if you look at subsection 2, it's very clear. Annual return shall be completed within 30 working days. And if you look at section 1, what does it say? Every company shall. So So it's mandatory. There is an obligation on each and every company to file this. Even a company limited by guarantee has to file this annual return. So again, while referring to section 131, you can answer the question, the second question, that is there a statutory obligation to file this return? So you can say, as this is a requirement to be fulfilled under section 131 of the Companies Act, the filing of the return is a statutory obligation of the company. Now, we understand that further, because since it's a statutory obligation, if you have failed to do that, there should be consequences. So that is another way that you can understand whether it's a statutory obligation, because if you have not fulfilled a statutory obligation, then you will be penalized for that. So if you look at here, section 131, subsection 4, what does it say? Where a company fails to comply with the requirement of subsection 1 or subsection 2, that is, filing a return in the prescribed form and filing it within 30 days from the end of the 30 working days from the annual general meeting. If you have failed to fulfill those requirements, what happens? The company shall be guilty of an offence and be liable on conviction to a fine not exceeding 100,000 rupees, and every officer of the company who is in default shall be guilty of an offence and be liable on conviction to a fine not exceeding 50,000 rupees. So both the company and its officers, such as the directors and the company secretary, can be held responsible if they have failed to file the annual return as required under the Companies Act. That indicates this is a statutory obligation. So in your answer, yes, you have to say that this is a statutory obligation under section 131, subsection 1 and 2 of the Companies Act, and failure to fulfill this requirement will result in certain penal provisions as per section 131, subsection 4, and you can refer to part A, subsection A and subsection B of 131, subsection 4. Explain what are the consequences if you have failed to fulfill this statutory obligation. So that's the answer to the second query. Then who should sign the return? Who should sign the return? And that is also provided in the Companies Act. So here if you look at the fifth schedule to the Companies Act, it says the annual return, even fifth schedule, not only fifth schedule here, 131 subsection 2. Look at the last part. The company shall forthwith forward to the registrar a copy of the return signed both by a director and the secretary of the company. So who should sign the annual return? Very simple and straightforward. Only thing you should know the relevant section. So it should be signed both by a director and the secretary of the company. So when you answer those three queries, then you secure 5 marks altogether. Then we come to the next part. So a shareholder of the company wants to inspect certain documents. So by referring to the relevant provisions, you have to explain whether this particular person as a shareholder of the company is entitled to inspect the documents provided here. What are the 3 documents that he wants to inspect? What are the 3 documents? One is the minutes of the annual general meeting for 2021, as he had not got a copy of it. Then its interest register. You know the interest register. So basically, if a director has an interest in a given transaction, then he has an obligation to disclose his interest to the other directors of the company. So that interest must be specifically stated in a separate register which is known as the interest register. So this shareholder wants to check the interest register. He wants to check the minutes of the AGM for 2021 and also the personal tax return of the chairman of the company, as he has got to know that it had been prepared by the accountant of the company. So we have to now explain whether he is entitled to check these documents as a shareholder. For this we need to look at section 118 of the Companies Act. Section 118 of the Companies Act. Here, inspection of company records. Subject to the provision. So, if you look at 118, it is inspection of record by directors. Then 119 is by inspection of company records by shareholders. Now, in this question, he wants to check these documents not as a director but as a shareholder of the company. Therefore, the relevant provision is actually section 119. So, in addition to the records being made available for public inspection under section 120. So, 118 refers to the documents that can be inspected by the directors of the company. 119 refers to the documents that can be inspected by shareholder of the company. Section 120 refers to the documents that can be inspected by any third party, that means the general public. But since this person is a shareholder, we need to check the documents that can be inspected by a shareholder. Now, you can't, out of the blue, you can't just visit the registered office of the company and request for these documents. You have to first notify the company in writing that the documents that you want to inspect, because you have to give them a reasonable time period to make those documents available. So, subsection 1 says, in addition to the records being made available for public inspection, a company shall keep the following records available for inspection in the manner prescribed in section 121 by a shareholder of the company or by a person authorized in writing by a shareholder for that person, who serves a written notice of such intention to inspect the company. These are the documents. Minutes of all meetings and resolutions of shareholders. So, when you say meetings and meetings, it includes the annual general meeting as well. Then, copies of written communication to all shareholders or to holders of a class of shares during the preceding 10 years, including annual reports, financial statements and group financial statements. Then certificates issued by directors under this act. Example, solvency certificate issued by the directors. Then here D, the interest register of the company. The interest register of the company. So, obviously, you can get the minutes of the annual general meeting. You can check the interest register of the company. So, these are the documents that can be maintained, and it is the responsibility of the company to make these documents available to a shareholder. So, these are the documents that can be inspected in addition to these documents. Now, these are the documents that must be made available to any person. Even though you are not a shareholder, the company must make available the certificate of incorporation, the articles, the share register, the register of directors and secretaries, and the registered office details, and the copies of instruments creating or evidencing charges register in other words. So, shareholders can obviously check these documents. Apart from that, they can inspect these 4 documents as well, these 4, A, B, C, D, right. So, now we will be able to answer the question. So, of course, the minutes of the AGM, he can definitely inspect as per section 119 subsection 1A, minutes of all meetings and resolutions of shareholders. So, you are permitted to inspect. And then interest register, yes, we saw it, 119(1) simple D. The interest register of the company is also a document that can be inspected by the shareholders of the company. If you look at the third one, even if you use your common sense, you will be able to answer. Now, personal tax return of the chairman. He might be the chairman of the company. You can inquire into something that he has done as the chairman of the company. But his personal income tax return is a confidential document. It's a document that you have submitted to the Inland Revenue Department. It's a confidential document. So, it's not a public document that can be made available. Even though the income tax return of the chairman has been done by the accountant of the company, that's a personal document. The Companies Act will not permit you to inspect the private and confidential documents of a director or the chairman unless it's something to do with the company. So, you can see that is not a document that can be inspected as per section 119 subsection 1. So, here you can see, so accordingly when you are answering the question, so as per section 119 of the Companies Act, the shareholders are entitled to inspect certain documents after making prior request for inspection to the company. So, you mentioned that is under 119 subsection 1. So, the minutes of the all meetings and shareholders 119 1A and then 119 1D, the interest register, are some of these permitted documents. So, therefore, you can come to the conclusion Virat, who is a shareholder of the company, after making a prior written request, is entitled to inspect those two documents, the minutes of the AGM and the interest register. However, the personal tax return of the chairman of the company, even though it's prepared by the accountant of the company, is not a document that is permitted under the Companies Act to inspect, because it's a private and confidential document. Therefore, we has no right to request the company to provide a copy of the personal tax return, so the company will have to refuse it. So, the answer to this question is completely based on section 119 of the Companies Act. So, there you secure 5 marks. So, here question 6 has 2 parts actually. A, there they have allocated 10 marks altogether, 5 marks each. Then the same question has another part, because at the end of the day you can score 20 marks from this question. So, let us look at part B now. So, Padmasiri Pereira is a director of ABC Private Limited. So, hereafter known as P, is a director. Is also a partner of his family furniture business, Fit Furniture, in which his wife is the managing partner. Recently, APL called for quotations to purchase new office furniture for the company. The procurement committee of APL that is the company where Padmasiri is a director, has sought the approval of its directors to purchase this furniture from EF as their price was the lowest. The procurement committee of APL has sought the approval of its directors to purchase this furniture from FF as their price was the lowest. So, they have given approval. In the meantime, the directors were told by the accountant of APL that Leela Ratna Silva, the auditor, has suddenly resigned in the middle of his term. That's another question. According to the accountant, L has not followed, that is, the auditor has not followed the procedure laid down in the Companies Act in relation to this resignation. So, 2 questions again. explain to P what he should do, keeping in mind his duties as a director of APL with regard to this proposed transaction with FF. Then Roman 2, explain whether or not L can resign mid-term and procedure that L should have followed if he wanted to resign. Okay. So let's take one by one. First, you read the question very carefully and understand what has happened. The first one is, your company, you mean Padmasiri here, he's a director of APL, and your company APL is entering into a contract with another business. They call it Fit Furniture, FF. So it's a partnership. It's a partnership. So in that business, Padmasiri is a partner. It is his family furniture business. And his wife is the managing partner. So your company, where you are a director, is entering into a transaction with another party, where you are a partner of the partnership. So it's like this. It's like this. So APL is the company where you are a director. You are a director of this company. And your company is entering into an agreement with another partnership. We call it FF, Fit Furniture. And it appears that this director, Padmasiri, is a partner of this partnership, and his wife is the managing partner. Now, you can see, of course, a company is a separate legal person. It has the ability to enter into any transaction with any other party. But in this instance, very clear, Padmasiri as a director has an interest in this transaction. He has a personal interest in this transaction. Why does he have a personal interest here? For two reasons. One is, he is a partner of the seller of furniture. So the company is going to buy furniture from FF. So FF is the seller here. So you are a partner of that business. So when you are running a business, your intention is always to sell your products at a profit and increase the profit margin as much as you can. So that is your objective. But on the other hand, so that you can't complain about. I mean, that's nothing for you to complain about it. You are running a business, so you want to sell your products at a higher price and to increase the profit. But here the issue is, you are a director of a company. That company is purchasing furniture from your furniture shop. So from one hand, you want to sell your furniture at a higher price, at a profit. On the other hand, as a director, you have a duty towards your company. You have a duty towards your company. Now, here, one hand you have a duty, and on the other hand, you have a personal interest in this transaction. That is, you are thinking about the profit that you can generate. And not only that, this business is managed by your wife as well. It's a family business. So in that case, one hand you have a duty towards the company. You have to give the best to your company whenever the company is entering into a transaction with another party. On the other hand, you have a personal interest. We call it conflict of interest. Conflict of duties here, because you have a duty towards the company. On the other hand, you have a personal interest. The company law is very clear. When you have a duty towards the company, it must always be prioritized. Your duty towards the company should always be given the priority over your personal interest. You have to always forget about your personal interest, you have to prioritize the duty that you have towards the company. But that doesn't mean your company cannot enter into transactions with your business. A company can purchase goods or any other asset from a business of a director. It's not prohibited. But the only thing is, if you have a personal interest in a given transaction as a director, you have an obligation. It's a duty that every director has. We call it duty to disclose any interest in a given transaction. Yes, you have an interest, that is okay, but it must be disclosed to the other directors of the company. You must disclose your personal interest in this given transaction to the other directors of the company. Failure to do that will be considered as a breach of duty towards the company. So after disclosing it, the company can make a decision, the other directors can make a decision whether they want to proceed with it or not. Now, according to the question, it's very clear. I mean, it's a beneficial transaction to the company also, because they have quoted the lowest price. In a way, it's good because the company will be benefited. But the requirement is you have to disclose your interest to the company, because you cannot make any secret profits out of a transaction. Secret profits cannot be generated. So when you disclose it, it's not going to be secret. Therefore, the company can decide whether they want to proceed with this transaction or not. If they don't want, then obviously they can cancel the transaction. Your only obligation as a director to disclose it. So this question is tested from that area actually. So let's look at the facts of the question. Recently, APL called for quotation to purchase new office furniture for the company. The procurement committee of APL, the purchasing committee, has sought the approval of its directors to purchase this furniture from FF as their price was the lowest. In the meantime, so that's the first part of the question. So based on that, we have to answer the question Roman 1 of section B. So explain to P, who's a director, what he should do keeping in mind his duties as a director of APL with regard to the proposed transaction with FF. So there you have to look at section 191 of the Companies Act. So let's look at that. So you can see section 100 transactions in which a director is interested. First of all, we need to figure out whether this particular transaction given in the question fall within the definition of interested. Subject to the provisions of subsection 2, for the purpose of this act, a director of a company is interested in a transaction to which the company is a party if and only if the director. So like then under 191, they give certain situations which can be considered as situations that the director is having, the director is interested in a transaction to which the company is a party. So we have to first look at whether the transaction that the company is now going to enter into with FF Fit Furniture Partnership is a transaction which falls within the definition of interested. So here it specifically explains how to determine whether a director is interested in a given transaction. Is a party to or will or may derive a material financial benefit from the transaction. Is a party to or will or may derive a material financial. Obviously, Padmasiri will derive a material financial benefit because he is a partner of the partnership. Has material financial interest in another party to that transaction, since his wife is also a party to this transaction, obviously the meaning of this interested will be covered. So first you decide whether this transaction is covered under section 191. Then you come to the conclusion, yes, P has an interest in this given or proposed transaction. If that is the case, then he has an obligation under section 192 to disclose his interest to the other directors of the company. So, that is governed by 192. So, first under section 191 you decide whether the proposed transaction is a transaction covered by section 191. If you come to the conclusion, yes, it's covered by 191, that means the director is interested in that proposed transaction, then his obligation under section 192 comes into play. Accordingly, he has to disclose his interest in this particular way. Let's say a director of a company shall forthwith, after becoming aware of the fact that he is interested in a transaction or proposed transaction with the company, cause to be entered in the interest register. We looked at, even little while ago, we looked at, because in the previous question they asked whether the shareholder can check the interest register. So, they are referring to same interest register, because from the interest register you can figure out whether the directors of the company have entered, whether the directors of the company have any personal interest in a given transaction or transactions entered into by the company. If the company has entered into a transaction where the director or directors have a personal interest, that must be disclosed and should be recorded in the interest register. So, anyone, especially the shareholders of the company, can inspect to see what kind of an interest that these directors are having. So, more than one director disclose to the board of the company the nature and extent of that interest. So, now let us answer the question accordingly. You can say a director of a company is considered to be interested in a transaction if he receives a financial benefit, that is here the definition 191. Is he received a financial benefit from the transaction, or he has a financial interest. You can copy these things from the section and you can write it in your answer, because you have to explain. So, to explain you have to obviously extract the relevant parts from the section. If he receives a financial benefit from the transaction, or if he has a financial interest in another party to the transaction, or if he is a director, officer or trustee of another party to a person who will or may derive a material financial benefit from the transaction, not being party or person, that is, and only the important parts you can extract from the section and you can write it down. Even this you can say here, the parent, child or spouse of another party. So, obviously your spouse is also a partner of managing partner of this business. So, because of that also you have an interest, even though you are not a party, even though you are not a partner. If your spouse is a partner, so of course still you have the personal interest under section 191. So, first you explain section 191, you write the main parts copying from the section, and then you come to the conclusion that then you should come to a conclusion. So, as per section 191, it is very clear, according to the given scenario, Padmasiri, who is the director of this company, falls within the category of an interested director, category of an interested director. So, it is very clear. Then, if you fall within the definition, then what is your next responsibility or duty? So, then as per section 192, the director shall enter in the company's interest register when he has an interest in a transaction or proposed transaction with the company as per section 192, and this disclosure must set out the nature, what kind of a interest that he is having, because he is a partner of the partnership, because his wife is also the managing partner. So, you have to disclose the nature and the extent of that interest as per section 192. Therefore, here P, Padmasiri, as a director, has a duty to disclose his interest in the proposed transaction to the company as explained above. 191, explain whether he's an interested director. Then you explain his obligation as per section 192. So, there you can score 5 marks for that area. Then of course, another area that you guys are definitely familiar with, the appointment, removal and the resignation of an auditor. So, here normally when an auditor is appointed at one annual general meeting, and his appointment comes into effect from the end of that annual general meeting until the end of the next annual general meeting. So, once normally an auditor is appointed at an annual general meeting, so his appointment comes into effect once a AGM is over, it comes into effect and it lasts until the next annual at the end of the until the end of the next annual general meeting. But does that mean the auditor cannot resign from his position prior to that? Definitely he can resign. But if he intends to resign or if he wants to resign, he cannot just resign. There is a procedure to be followed. So, this question is actually from that area. Yes, an auditor can resign in between. Normally, he is appointed at the AGM. So, his office comes into effect from the end of the annual general meeting where he was appointed to the until the end of the next annual general meeting. However, an auditor is permitted to resign prior to that. In between he can resign, but there he has to follow a procedure, because the most important thing is that the shareholders of the company should know why he is resigning, because auditor is supposed to be an independent person. So, if an auditor is resigning, that can be due to a very serious issue, because it can be a situation where the auditor is not in a position to maintain his independence. Sometimes there can be situations where the auditor is influenced by the directors of the company, or else the company is not providing the information requested by the auditor. In such situations, the auditor will not be able to perform his duties and he may decide to resign. Therefore, the auditor is appointed by the shareholders of the company. So, the auditor's agreement is actually with the shareholders, because shareholders are the people who will appoint an auditor. So, if an auditor is resigning, the shareholders should know the reason behind it. So, this procedure has been developed to that extent for that particular purpose. Accordingly, the auditor can resign, but he has to give reasons for his resignation. If there are no such special reasons, that also he has to mention, saying that he doesn't have special reasons to mention. With or without reasons, you have to disclose it to the shareholders of the company and then you can leave. So, that is the procedure that he has to follow in this situation. So, let's look at the answer. For this, we will look at section 161 of the Companies Act. Let's see. Here you can see the highlighted part. If an auditor resigns or ceases for any other reason to hold office, he shall deliver to the company a statement of any circumstances connected with his ceasing to hold office, which he considers should be brought to the attention of the shareholders or the creditors of the company, or if he considers that there are no such circumstances, a statement that there are none. So, if you have reasons, you have to say these are the reasons behind his resignation. If there are no such reason, that also he has to mention, saying there are no such reasons, special reasons for him to resign, but for some, for personal issue or something like that, he is resigning. But there are no special reasons that he wants to bring to the attention of the shareholders or the creditors of the company. So, the statement required under subsection 1 shall be delivered by the auditor if he resigns with notice of his resignation. So, you can see it is an obligation. Here, where an auditor fails to comply with subsection 1, he shall be guilty of an offence and be liable on conviction to a fine not exceeding 200,000 rupees. So, as as accountants to be, most of the time, you guys are already working for audit firms. One day you will become a partner of an audit firm. So, in that case, you should know your obligations under the Companies Act as an auditor. So, what if you want to resign? You can't just tender letter and resign, because you have to follow the relevant sections of the Companies Act, particularly section 161, subsection 1 of the Companies Act. So, accordingly, we can answer the question now. An auditor can resign and cease to hold office for any reason at given time. No restrictions for that. You can resign at whenever you want. So, it is possible. Therefore, Leela Ratna Silva in this situation can resign mid-term. However, in doing so, the auditor must follow the procedure laid down in the Act, and that is laid down under section 161. Accordingly, you can copy the relevant parts from this section and include in your answer. So, sometimes students have this problem, especially writing answers. When it comes to theory papers like this, you find it little difficult to formulate your sentences. So, in that case, you start thinking how to write down the sentence. Then you think you have to think about grammar, and most of these things you have to think about all these things when you are writing a sentence. Sometimes you might be having difficulties in communicating. So, there is a shortcut, because you can take the Companies Act with you. In such situation, what you can do is you can use the words, the terms provided in the section, extracting those sections and include in your answer rather than using your own language here. Not required to use your own language. Preferably you should use the language provided in the Act, because then for the examiner also it's convenient, because normally when they formulate the answer scheme also, they extract the relevant parts from the Companies Act, because the questions are based on these statutory provisions. Therefore, the language used in the Act, like when you answer an audit paper, the language used in the standard must be used. Then you can easily score good marks rather than using your own language. Here also the same. Not required to use your own language. Instead, use the language provided in the section and give the answer. So, you don't have to think straight away. You have to just extract it from there and write in your answer. So, here you have to say auditor can resign at any time. However, the procedure must be followed as per section 171. Accordingly, what does he have to do? He shall deliver the company a statement of any circumstances connected with his ceasing to hold office, which he considers should be brought to the attention of the shareholders or creditors of the company, or if he considers that there are no such circumstances, statement that there are none. So, this part you can copy and include in your answer. And the copy of this statement must be sent to the shareholders of the company as well. Here, As per subsection 3, if the auditor has stated circumstances which he believes ought to be brought to the attention of the shareholders or creditors, the company shall send a copy of the statement to each shareholder and deliver a copy of the statement to the registrar as well. If there are no such reasons, then he must deliver a statement to that effect to the company. Then you have to say no such reasons to mention. But it's the obligation of the auditor. If you fail to do that, you can refer to subsection 4 also, where auditor fails to comply with that requirement, then he shall be guilty of an offence and be liable on conviction to a fine not exceeding 200,000 rupees. So, everything you did not have to memorize, you should only know the relevant section. You go there and extract the relevant parts and include in your answer. So, with that we complete that question number 6 fully. So, there were two sub questions. Each sub question had two separate questions to be answered. So, there were 4 questions altogether, allocated 5 marks each. So, now we have answered the full question for 20 marks. And then we will look at the next question under section 3, question number 7, again allocated 20 marks for this question. So, let us read it and see. Ravi contracted to sell his land situated near the Bolgoda lake to Gamini. Later, with the sudden rise in land values, Ravi changed his mind and formed a limited liability company in which R became the sole shareholder and sole director, and without informing G, R sold the land to R's new company. G is of the view that R has breached his contract with G and therefore wishes to file action in court for relief. In this regard, G, the buyer, Gamini, seeks your opinion as to whether his action for relief has a chance to succeed. Discuss G's query with reference to the facts and decisions of a decided case. Actually, whatever the facts that you have been given here are based on a case law. There is this case called Jones versus Lippmann. These facts are actually based on that particular case law. So, Jones versus Lippmann. So, let us look at what has actually happened in this situation. Let us see what has actually happened here. Right. First, you need to understand the scenario before answering. Okay, here the seller, yeah, he's Ravi, he's the seller, Ravi. He has entered into a contract with G, Gamini, who is the buyer, that is to sell a plot of land. He has already agreed to sell this land at a particular price. So, there is a binding contract between R and G here. There is a binding contract between R and G here to sell the land. But since the market price has increased, now Ravi has changed his mind. Therefore, he wants to keep the land. He doesn't want to sell it at the price agreed. He wants to keep the land, or he doesn't want to sell the land at the agreed price. Therefore, what he has done, he has incorporated a new company. He has incorporated a new company where he is the shareholder, sole shareholder and the sole director. Then what he has done, he has sold this land to this company Obviously, if you look at separate legal personality principle, and if you look at Salomon principle, as per the case Salomon versus Salomon and Company, it was held that the company is distinct and different from its shareholders. The shareholder and the company are not the same. Company on its own, once it's incorporated, it's a separate legal person. Therefore, as a separate legal person, this particular company can enter into any transaction. They can even enter into a transaction with its shareholders. So that is what has happened here. The company, as a separate legal person, has purchased this land from its shareholder. So, as a separate legal person, the company now owns this land. The company owns this land. It's under the name of the company. So, now the company can do whatever they want with this land. Now, this is what has actually happened. However, G says, here you agreed to sell this land to me at this particular price. Now you are refusing to sell it. In fact, you have now transferred it to a different party, to a company. So he wants your legal advice whether he can file an action against R to obtain this land as he agreed. He agreed to sell the land. G wants a legal opinion and advice to see whether he can obtain this land as agreed with Ravi. So basically here you are seeking something called specific performance. Don't think too much about it. There are different types of remedies available if there is a breach of contract. This comes from law of contracts. Obviously, it's not part of your syllabus. However, now there is a contract between the two parties. It's very clear Ravi is in breach of this contract. Normally, if a party is in breach of contract, the other party can claim damages. The other party can claim damages. So, in this situation, if G wants to claim damages, Ravi might be willing to pay damages to Gamini because, here still he can keep the land. The price has increased. So, Gamini has to show these are the damages that I suffered as a result of this breach. Nothing much if you quantify the damages. So, he could not purchase this particular land, then he will have to buy some other land at a different price, right? Maybe at the same price or at a different price. So, here Ravi may not be having any issues of paying damages, but that is not what Gamini wants here. He wants the land. He doesn't want damages, he wants the land. He wants the land from Ravi here. This is what we call specific performance. Specific performance. Specific performance. What do you mean by specific performance here? You want an order from court compelling, forcing Ravi to sell the land as agreed. Specifically perform what you agreed to do under the contract. That is what we call a specific performance order. Specific performance order. You agreed to sell the land. Now you sell the land as agreed. So you want to get an order to that effect. Getting an order, obtaining an order, forcing the seller to sell the land as agreed. That's what you want. So they are asking whether Gamini will be successful in that situation. There is a judicial precedent. There is a previous case which is very much similar to the facts of this case, as I mentioned, that is Jones versus Lippmann. Same thing occurred. Same thing occurred. So if you know the judgment of this case, you can say, as per judicial precedent principle, the court will be bound to give the same judgment. If the same judgment is given as provided in the case of Jones versus Lippmann, then J will be successful. He will be successful. Because what happened in the case of Jones versus Lippmann, the facts were very much similar, exactly the same. In that case, the court made a specific performance order. Because there are some other principles that you have to address here. The argument came from the seller's side, from Ravi's side, was that here the company is a separate legal person. Now the company is the owner of the property, not me. The shareholder and the company are not the same, as held in the case of Salomon versus Salomon and Company. However, we have learned another concept called lifting of the veil of incorporation. 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 Accordingly, even though the company is a separate legal person, there are certain instances where the court would intervene to lift the veil of incorporation. Yes, the company and the shareholders are not the same. The company is a separate legal person. It's mainly because of the fact there is something called veil of incorporation. Veil of incorporation that makes the company a separate legal person. But there are certain instances where the court is permitted to lift the veil of incorporation. There are certain situations where the court can intervene and remove or lift or raise the veil of incorporation and look through the company to find out the people who are behind the company. It's very clear here, in this situation, this company was not created for a business purpose. This company was not created for a business purpose, not for trading purposes. The whole the objective of the incorporation of this company is to avoid his legal obligation under this contract. So there is no genuine intention behind the incorporation of this company. Normally you incorporate a company to do a business. Here the company was not incorporated to do business. Therefore we say this kind of companies are basically bogus, or we call them, it's a sham, fake company. It's not a company that you have incorporated for a genuine commercial purpose. It's a sham. It's a fake company. It's a bogus company. In that case, the court can lift the veil of incorporation. The court can lift the veil of incorporation because in this instance, Ravi, with a fraudulent intention to avoid his contractual obligation to sell the land as agreed, he incorporated this company and transferred the land. Therefore, this company was not incorporated for a genuine commercial purpose. It's a sham company. Therefore, the court can lift the veil of incorporation. What is the outcome of lifting of the veil of incorporation? When you lift the veil of incorporation, what happens is the shareholder and the company will not be considered as two separate persons. The shareholder can be held personally responsible. The shareholder and the company will be considered as one actually. The company will not be considered as a separate person. Once a veil of incorporation is lifted, one outcome is the shareholder and the company will not be treated as two different parties. The company will not be considered as a separate legal person. And also, you can make the shareholder personally responsible for what he has done. Accordingly, in this instance, if you lift the veil of incorporation, what happens is the transfer of this land will be considered as null and void. the transaction will be void. If the transaction is made void, that means this is not a valid transaction. This transfer of the land to his company with the lifting of the veil of incorporation will be considered as a void transaction. So, if it is treated as a void transaction, that means the transfer of the land will be cancelled. In other words, the company is no longer the owner of the land, still the ownership of the land with Ravi. So, the land is still with him. Then obviously, the court can make an order to transfer that land to Gamini as agreed under the contract. So, this is what happened in the case of Jones versus Lippmann. So, if the following with the judicial precedent, because if a court has given a judgment in the past with similar facts, then normally the court will give same judgment in the future as well. That is what we call judicial precedent here. The lower courts are basically bound by the judgments given by superior courts. Don't think too much about it. But what you need to understand, the facts are very similar. Therefore, the same judgment should be given. That means Gamini will be able to succeed in his litigation if he proceeds with it. So, that's the answer that we can give. So, let's formulate the answer now. Right. So, here they are asking, if you look at it, the required part, G's query with reference to the facts and the decision of a decided case. So, they are specifically referring to the decided case which I have mentioned here. So, best to start your answer with that judgment. So, the information provided in this scenario is very much similar to the facts of the case of Jones versus Lippmann. And Jones versus Lippmann. So, what you can do is these cases relevant to the Companies Act. So, at the beginning you have the separate legal personality, because if you look at section 2, section 3, from there onwards they explains how a company becomes a separate person once it is incorporated. But these are exceptions to that, lifting of the veil of incorporation. So, you go near section 2 or 3 and you write down this case Jones versus Lippmann and the rationale of the judgment as I mentioned. So, these things you can write it down near the relevant section. So, you can obviously take that with you to the examination hall. So, anyway, the facts are very much similar to the case Jones versus Lippmann. So, accordingly, if I may reiterate reiterate an important part that was held in the case of Jones versus Lippmann. It was held that the company is actually a creature of a device and a sham. I use the word sham. A creature means here fraudulently you have used the incorporation principle to create a fake company. You have created something. So, if you have created something, what you have created, we call it the creature. You are the creator and you have created something. That something that you have created is your creature. So, creature of a device and a sham, a mask or veil, he holds before his face. Ravi is holding in this situation, he is wearing a mask and say here, I don't know anything about this company. The company is a separate legal person, the land is now with the company. If you want the land, you ask from the company. The land is not with me. He is wearing a mask. What is the mask that he is wearing here? The veil of incorporation, because veil of incorporation creates a company and makes the company a separate legal person. So, you are trying to hide behind this the veil of incorporation. You are trying to hide your face saying here, I am not the company is a separate legal person. Now, the land doesn't belong to me, it's with the company. But when you remove the mask, when you lift the veil, what happens is you clearly see the people who are behind the company and you make them personally responsible, and that is what happened in the case of Jones versus Lipman. So here, applying the ratio of the judgment, Jones versus Lipman, so basically we can come to the conclusion, that the company cannot escape from or divest itself of its knowledge gained through the director. So the company is basically not a company created for a genuine commercial purpose. It's a sham. Therefore, by lifting the veil of incorporation, you can obtain a specific performance against the company and the director. So here you have learned the instances where the veil of incorporation can be lifted. One such situation is fraud. There's fraud involved because Ravi has fraudulently created or incorporated this company to avoid a contractual obligation. So that is definitely a ground under the Companies Act to lift the veil of incorporation, right? So in this situation, it is obvious that Ravi has formed the company for the fraudulent purpose of avoiding the contractual obligation. Therefore, there is a good possibility of succeeding if G. Gamini files an action in court, and that the court will follow the judicial precedent set out in the case of Jones versus Lipman. So this will result in the lifting of the veil of incorporation and prevent a fraud from taking place. So the sale of the land from R to the company being made null and void. So then the transaction will be cancelled. If the transaction is cancelled, then the owner of the land will again become Ravi, and as agreed under the contract, now you can get Ravi to sell the land to Gamini. So therefore, he will be able to, he has a fair chance of succeeding in this, in his proposed action as explained. So the possibility is high since there is a very valid judicial precedent to apply. So that is how you should answer part A, where they have allocated 10 marks for that question. Then we come to the last part of the second question. Again, they have allocated 10 marks. So with that, we can actually conclude section 3. But here, next part consists of several questions. Sometimes it's easier because then you don't have to write lengthy answers. So let's see. Perumal worked for a leading private company for 30 years as an accountant and retired recently. Recently he received his EPF payment of rupees 10 million. Now he wants to invest these monies in a company owned by a friend of his by way of purchasing its shares. The type of shares P intends to invest in are those that will give him yearly dividend, which in turn will guarantee him a steady income during his retirement. So we have to read it very carefully. So he has worked as an accountant for 30 years. Now he is retiring. He has an EPF of 10 million. He wants to invest this in a company owned by a friend of his. Look at his requirements. You need to highlight them. Now, since he is a person who has retired, during his retirement, he wants an yearly dividend. The type of shares, so he wants to invest in type of shares that will give him a fixed return, give him yearly dividend, which in will turn guarantee him a steady income during the retirement. So for you to get a fixed return, fixed dividend with a guarantee of income, then of course ordinary shares will not be the suitable one, isn't it? You need to have a preference dividend, because if you invest in ordinary shares, there is no guarantee that you will be able to get a return. The company has no obligation to pay you dividend if you are an ordinary shareholder. Even though the company is profitable, still there is no obligation to pay dividend if you are an ordinary shareholder. But if you are a preference shareholder, then obviously the company has an obligation to pay you a fixed dividend. So that gives you a guaranteed return. So anyway, let's say Nelson, his neighbor, told him that there are two types of shares which are entitled for yearly dividends. So that is what they have mentioned about those. One such type of share is ordinary shares. Unfortunately, N could not remember the name of other type of shares. So I have already mentioned it is preference shares where you are entitled to a fixed dividend, recognized by the Companies Act, and which gives a fixed yearly dividend. That's preference shares. Additionally, P is also considering functioning as the promoter of a company to be incorporated and wish to retain control over this company. During his working life, he has heard of shares which are issued to promoters which enable them to retain control over the company. Control over the company. Right. So here the first question. So basically, for you to retain control over the company, you have to have the ability to participate in the management of the company with voting powers, and for you to retain the control to others, you should always issue non-voting shares. You keep the voting power. When you want to raise funds, issue shares to others without any voting rights, So let's see the first part of the question. Explain to P which of the two types of shares suggested by N is best suited for his requirement of getting a steady income during his retirement. So two types of shares, ordinary shares and preference shares here. Now for this we can look at section 49. Section 49 allows a company to issue different types of shares. Let's say now a share in a company shall be movable property. Subject to the company's articles, a share in a company shall confer on the holder the voting rights, equal share in dividend and equal share in the distribution. Now, if you take an ordinary share, there is no guaranteed dividend. Even though the company is profitable, as I mentioned, there is no obligation for the company to pay you dividend. No obligation. Then on the other hand, ordinary shareholders, they have voting powers, that's true. However, at the time of liquidation of the company also, first priority must be given to the preference shareholders before settling the debts to the ordinary shareholders. Ordinary shareholders' capital will be paid last. Preference shareholders' capital will be paid before settling the capital of the ordinary shareholders. So that is why we call them preference shareholders, because when you are paying dividend, you have to give them the preference. When you are liquidating the company, you have to give them the preference over the ordinary shareholders. And so those are the main two, especially when it comes to dividend and distributions. Distribution at the time of liquidation. Then a company may issue different classes of shares, and particular may issue shares which are redeemable. You know what redeemable shares are. Normally when the shares are issued, they are irredeemable. That means they are issued forever until the company is liquidated. Most of the time ordinary shares are like that. if you invest in ordinary shares, you can't force the company to pay your money back. The company has no obligation to pay you money. You have to wait until the company is liquidated. Otherwise, what you can do is, you can sell your shares to some other person. But you can't ask the company to buy your shares, but there are limited circumstances where you can do that. But in general, until the company is liquidated, you cannot demand the company to buy your shares back from you, right? So, unless you transfer it to some outsider who has agreed to become a shareholder of the company, that's a personal transaction. But those are irredeemable. But redeemable shares are basically issued for a fixed time period, maybe 5 years, maybe 10 years. At the end of that time period, you can take your money back. But here the relevant part is confer preferential rights to distribution. So, they are referring to preference shares. And confer special limited or conditional voting rights, or confer no voting rights. So, that is relevant when it comes to the second part of the question, So, let's look at that part later. Right. So, answering the first part of the question, which two types of shares suggested by N is best suited for his requirement? The type of shares which the Companies Act number 7 2000 recognizes as having fixed dividend. Here 49, subsection 3, subsection B. This is the best type of share suitable to the requirements of this particular person. So, confer preferential rights to distribution. So, that's the answer basically. 49.3b, and then you, since they have allocated 5 marks, you have to explain the benefits, how you can achieve the requirements stated here. So, what happens when you invest in shares with shares which confer preferential rights to distributions. So, there you have to mention they are basically ranked above ordinary shares when it comes to financial benefits, such as the preference shareholders' dividend must be paid prior to the ordinary shareholders. And the other thing is, ordinary shareholders are not entitled to a fixed dividend. It varies depending on the profitability of the company. But if you are a preference shareholder, profitable or not, you are entitled to a fixed dividend. That is one of the main requirements. Guaranteed income. So, here when you invest in preference shares, you know the fixed return or the dividend that you are going to get. And on top of that, your dividend will be paid before paying the dividends to ordinary shareholders. And at the time of liquidation also, you will be given the priority over the ordinary shareholders. And the other thing is, when it comes to this preference dividend, fixed dividend, it can be either cumulative or non-cumulative. You need to consider that as well, because there can be certain years due to the financial difficulties, the company will not be able to pay your fixed dividend, because the company does not have enough cash to pay your dividend. Then what will happen? This year's dividend will be added to the next year's dividend. You call it cumulative. But sometimes the preference shares can be issued non-cumulative. In that case, you will be in trouble, because this year's dividend, if it is not paid, it will not be added to the next year's dividend. Therefore, you have to consider that aspect as well. So, you should go for cumulative preference dividend. So, considering the requirements of this person Perumal, for him to have a steady income, the most suitable type of share is preference shares rather than ordinary shares. So, with that you can come to that particular conclusion and secure 5 marks for that question. Then state the type of shares which will enable P to retain control of the company as its promoter. So, if you want to retain control over the company, in the future, when you are going to raise funds, you should issue non-voting shares. Non-voting shares. So, that is the answer. It is only 1 mark. So, the type of share as per 49(3)(b) confer special, limited or conditional voting rights or no voting rights. So, in that case, the type of shares that enable the control of the company to be retained with Perumal as its promoter would be non-voting shares. Would be non-voting shares. So, then you will be the only person who is having voting rights in the company. In that case, others will not be able to control the activities or the decision making of the company. You are the promoter, you are having the voting shares, and you are not going, and you are the only person who has the voting rights, because as a company, for you to make decisions, you should have voting rights. If you don't have voting rights, your ability to influence the company will be restricted. So, here additionally, P is also considering functioning as a promoter of a company to be incorporated and wish to retain control over this company. Issued to promoters which enable them to retain control over the company. So, here non-voting shares. Then the state the salient features of the shares referred to in Roman 2 above. Not voting shares. What are the characteristics of non-voting shares? So, basically you can refer to section 49(3)(c), and these are recognized under 49(3)(c) of the Companies Act number 7 of 2007. These shares do not carry voting rights at all. So, these shares are usually issued for the purpose of retaining control with the promoters. So, when these shares are issued, the promoters can always maintain their control, because the new people will not be having any voting rights. So, that is how you should answer the question. Then finally, state the main difference between ordinary shares and the shares referred to in Roman 2 above. So, the main difference between ordinary shares are voting shares, and Roman 2 non-voting shares. So, the main difference is you have the right to vote. Ordinary shares, you have the voting rights, you have the right to vote, you can influence the decision making of the company, whereas non-voting shares do not give the voting right. That is the main difference, only 1 mark. So, ordinary shares are, in other words, voting shares, and there you have the right to vote as per here. Normally, when an ordinary share is issued, you have the right to 1 vote at a meeting of the company on any resolution. That is ordinary shares. But at the same time, the company is permitted to issue different classes of shares, such as non-voting shares, where you are not permitted to vote at a meeting. So, you cannot influence the decision making of the company. So, that is how it works. So, I basically answered all these questions based on the suggested answers provided by going through them as well. So, this is how you answer section 3 of the paper, right. So, now as the next step we can look at the MCQs given.